Hello everyone and welcome back. My name is Greg Furman and this is the VantagePoint AI Market Outlook for the week of December the 25th, 2023. Now, as we move into year end, we'll do a quick recap of where we are in the markets with an accurate viewpoint of where the performance has been in the fourth quarter. When we look at the dollar index, as outlined many times in this weekly outlook going back into September, October, the dollar does very poorly in November, December, and the better part of January. The dollar down 4.35%. The Fed has helped that out by suggesting that he's going to cut 2, maybe 3 times in 2024. That has pushed the equity markets even higher in this particular quarter at up 10.83%. Now, our key support level, our T-cross long, that's coming in at 46.61 for the remainder of the year, while we hold above that T-cross long, and our Vantage point, key resistance point, is 102.53. Now, the yearly opening price, very important, guys, that we're not looking at a rolling performance model. It's a lagging model that constantly produces false signals, much like what we've seen this week with oil prices, with some of the energy stocks, which I'll talk about in a minute. But again, we want to look at the current yearly, monthly, even the weekly opening price, and the quarterly opening price is very, very important because it's based on price. We then combine our Vantage point indicators with that price action, and that tells us where we currently are. And it's not subjective, it's objective. We know exactly where we are using the T-cross long and even the current monthly opening price. That price, 45.59. Now, again, when we look at gold prices in the fourth quarter, up 10.8%, a very strong move. We can see we're above our yearly opening price and our quarterly opening price. The monthly opening price with gold, we're struggling a little bit, but gold predominantly does very well in December and January, and then that seasonal pattern in dollar strength kicks in, usually around the end of January or early February. But our T-cross long here, or our key pivot area, is 2039. But the monthly opening price is a bit of a concern. I would like to see us hold above that at 2056. If we do a comparative analysis between that and platinum, we can see a very different. We're up 6.9%, but we've been in a very firm downtrend. So again, when we're looking at the difference between platinum and gold, gold remains above its yearly opening price, above its quarterly opening price. It's very strong. Now, platinum is starting to hold above its monthly opening price, but I believe that gold will be the winner between these two metals. Now, when we look at oil prices, this is one I think that's very interesting after the Fed. The accurate fourth quarter pricing, oil is down 18% here, guys. We did this back in October, November, when we broke down through the current yearly opening price. That led to a big sell-off. Now, the Fed has pushed oil up slightly, but again, the main thing we want to look at is the direct intermarket positive correlation between oil and the dollar. Dollar moving lower, oil moving lower. The dollar is down 4.35% in this particular quarter, which is the U.S. fiscal first quarter, by the way, but light sweet crude oil is down 18%. When we do a comparative analysis between some of these energy stocks, when we look at Callum Petroleum, CPE, it's down 15.17%. If you're buying this at the start of the week, right off the beginning of the week, you're rewarded with about another 5% drop. So again, accurate pricing is very important here, guys. So if we look at this past week, it's down 3.25% again, because the trader, you can see that we had a big spike up because of the Fed, but there's been absolutely no follow through on this. We're below the quarterly opening price. We're below the yearly opening price. There is nothing bullish about this particular setup. But again, these are the things we need to make sure we're looking at. So on a breakdown below the T-cross long at 32.60, the downside on this particular stock is likely to accelerate. So again, based on the seasonal pattern, oil is not usually strong until March and April. You get a little bit of a spike sometimes in mid-January. But again, the Fed bar, this is what the classic retail trader's mistake is, buying in to a big bar like this and zero follow through. So again, if we're going to be looking at buying something like this, this particular stock, we want it above 36.51 because again, nothing in this particular quarter has changed. If you look at a 5-day performance or a random 30-day performance, it's false, misleading pricing. That's the problem with the rolling performance model. So again, something to look at. The big winner in this particular quarter is again Bitcoin, up 60.12% in the fourth quarter. Now again, we were way ahead of this move back in October because of that strong seasonal pattern, but not a lot of bullish momentum up here at the current time because we're approaching new highs. That new high coming in on December the 8th. So again, unless we can get above that high and stay above that, there's a slight bearish feel to this particular asset class. But if we can hold above our T-cross long coming in at 42,523, then we should be able to make another break higher. But that probably won't be until the new year. Now, when we go into some of our main Forex pairs, or one more thing I will quickly look at is the VIX, because a lot of people use this again to gauge the equity market. The VIX in this particular quarter has been down 29.06%. So again, we want to make sure we have an accurate pricing model where we currently reside here so we can accurately determine the trend. Again, as we worked on in the VantagePoint live training room, we're not getting overly bullish on the energy stock. We're not getting overly bullish on platinum or some of these other models. But again, it's not that we can't buy them. We just we need a reason to buy them. And with these looking at direct intermarket correlations right now, absolutely, years and years and years ago, dollar down, oil up. But as of late in the VantagePoint software, what I'm seeing is the dollar down, oil down. So again, we'll continue to monitor these things, but the VIX still looking like we've got more downside ahead as we go into a potential Santa Claus rally. Now, when we look at some of our main Forex pairs, and again, understanding intermarket correlations before we start throwing 100 different indicators at something, we need to understand the basic structure of how this works. The euro makes up the bulk of the dollar index. So if the dollar index is moving lower, then the euro is moving higher. The little bit of a concern that I have here is we have a significant gap between the current price and the T-cross long on both the Euro-US pair and the dollar index. I think that any retracement will be minimal, but for now, the euro remains an excellent long. We can see our price structure, accurate price structure, not using a rolling performance, constantly moving the goalpost every 5 days, every 30 days. No, guys, that's not the way we want to do things. We want to look at this and say, okay, I'm up a solid amount on the quarterly price at 105.67. 107.04 is the yearly opening price, which we came within a matter of about 40 pips, and then we've had another significant rally on this. So again, looking at this price structure, we're above our monthly opening price at 108.88. Everything looks good here for the euro to extend higher, but a corrective move lower first is likely, but I can't say that that would be a significant model. Now, when we look at this dollar weakness, one of the ones we've also worked on in the VantagePoint live training room is the MGA stock. The MGA stock, using the advanced indicators in the VantagePoint software, has identified that MGA has a 94% inverse correlation to the dollar index. So as you can see, the second the dollar index broke lower, Magna International stock mysteriously had a big spike up, and some of that's earnings, some of these are different things, but the bottom line is, guys, the inverse correlation drove this. So that's something, just a little side note, because we've discussed this a lot over the last 3 months, waiting for this pending dollar weakness, that we could jump on this particular stock, regardless of what indicators say. The advanced indicators, the intermarket correlations, reign supreme here. Dollar down, this particular stock up, euro up. And again, there's a lot of people could make a very strong argument that the euro currency is no reason to strengthen, and I wouldn't disagree with that, but the reality is that it makes up a large part. And it's not about euro strength or weakness. It's about dollar strength or weakness and how it affects all of the other markets. So when we look at some of our other pairs, US Swiss franc, again, we've talked about this multiple times on two separate occasions that I did live in these presentations each week. This is why we use the current yearly opening price, guys, because again, it's impossible to script this because we've already been over it. The current yearly opening price coming in at 92.51. We hit that to the number, and it has since dropped from 92.51 to 86.90. In the Forex market, that is a massive trade, guys. Even on a $10,000 trade, you're doing a 9-10% return on your account on a tiny little $10,000 trade that costs less than $1.50 to take. That's the advantage of the Forex market over the stock market and even the futures market at times. So again, the US Swiss franc, we've got a bit of a gap here. We can expect a little bit of a corrective move, but as long as we hold below 86.96, then the primary trend remains down probably until at least early February. Now, not a lot of great data coming out of the UK, but once again, by simplifying these presentations down, using that T-cross long, it weeds out the noise. When people are saying do this, do that, we're not saying that. We're saying, look, the current factual yearly opening price, 120.97, the current quarterly opening price. I don't we shouldn't be concerned with the last 5 days, random 30 days, random 365 days. We want to make sure that we understand exactly where we are in 2023 in the fourth quarter in the current month. So we've come down, hit the monthly opening price, which was intersecting with the VantagePoint T-cross long. That led to another spike up on this particular pair. But again, if we look at the pound dollar here at the beginning of the quarter, the second we started moving above this quarterly opening price and we stayed above the VantagePoint T-cross long, then you can see we had a big spike up, a corrective move down to our T-cross long, and then up we go. Even though the data coming out of the UK has not been great, but for next week, our T-cross long, that's coming in at 126.26. The indicators, our neural index strength remain bullish. Now, as we look at the dollar yen, once again, I have discussed this at the beginning of this particular quarter that I did not think the yen would continue to weaken here. Because again, the dollar does not fare well in November, December, and most of January. And that's where the yen can pick up some ground here. If the Bank of Japan does intervene in any way, it's going to be even worse for the dollar. But, you know, the reason it got up here is partly because of the Bank of Japan intervening originally. So they created their own mess here. But for now, shorts definitely carry the edge here, while gold prices, metals remain firm. So our T-cross long here is coming in at 144.62. We've got a bit of a gap between the predicted high on Monday, Tuesday, I should say, the market being closed. But that T-cross long coming in at 144.62, I would hold off for a move somewhere up towards that area. I can also click on the VantagePoint F8 and bring in my long predicted. That level is coming in at 142.95. So between 143 and 144 would be your premium short level. Now, as we look at the US-Canadian pair, I believe we're getting ready for a reversal back to the upside on this pair because, again, the charts, the indicators in VantagePoint, the seasonals don't support the energy sector. They don't support light sweet crude to any real extent. So if crude reverses and goes lower again, well, or stays lower, stays in its primary trend, then even with this dollar weakness, I believe the Bank of Canada will be the next bank that signals rate cuts. And what happened to the dollar over the last 2 or 3 weeks will happen to the Canadian dollar also. I believe that will happen either way because Canada is the US is Canada's biggest trading partner. So if things are going into a recession in the US, I guarantee you they will go into a recession in Canada. I believe Canada is already in a recession. So we've got a large gap between the current price and our T-cross long is 134.60. I don't believe shorts are a good play for much longer here. I believe that a bear trap is actually setting up. So be very, very cautious with this one. I'll be looking in the next presentation. I'll be bringing in the T-cross long, or excuse me, the MA diff cross. But this pair, I believe, is a downside on US Canada is again very much overextended. Respecting the energy sector is still not doing well. Now, as we look at the Aussie and the Kiwi, they are really responding well to the equity markets. Metal prices moving higher, but predominantly the equity markets. Now, again, most traders will never even see this price here. It's like invisible resistance. 68.17 is the current yearly opening price. The market hit that level on Friday and stopped dead, hit a brick wall. So again, this is a make or break time for this. Either this pair goes higher or it sells off again from here. That could happen if stocks drop. But either way, we know the level. So even if you're a seller of this pair, then I support that freedom of choice. But if you're a buyer, maybe it's best to put your buy limit order up above 68.30. Just let it get above this yearly opening price, stay above that price, and then we should continue to move higher. But this will set the tone for 2024. So again, the indicators still remain bullish, but it looks like we've got a bit of a gap to fill. So all I have to do is click on my F8, and I've got my VantagePoint long predicted, 67.51. That is the level I would target for additional longs, anticipating a break of the current yearly opening price at 68.17. I believe we'll see the same thing with the Kiwi. The Kiwi has not yet approached its yearly opening price, but very, very close at 63.50. All we need to do is push above that, and the VantagePoint indicators combined with price action is a winning combination, guys, as long as we move away from the rolling performance model. And again, VantagePoint does not entertain or have any indicators in the 5-minute time frame or the 30-minute time frame, particularly cloud-based or percentage R-based indicators. The VantagePoint time frames are our daily, our weekly, and our monthly. You will never get a successful trade from a 5-minute time frame. 5-minute time frames respond to price. They whipsaw. They provide multiple false signals over and over and over again. So again, we've got a bit of a gap to fill here. If I click on my long predicted, which is my long-term crossover with just the blue line, you can see that the market is riding this blue line all the way up. And I would only buy this because I'm above the monthly opening price. Now, again, I would put additional longs above the current yearly opening price, at 63.50. So with that said, this is the VantagePoint AI Market Outlook for the week of December the 25th, 2020.